We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Hey, this is Tom. If you've found value in these interviews over the years, please don't forget to like and subscribe to the channel, especially on YouTube. I don't like to interrupt the show to do this, but it helps our channel to be seen, which has proven to be more and more difficult on certain platforms. Thanks. Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Vermeulen, founder and chief market strategist at the Technical Traders. Chris, thanks for joining me today. How are you?
I'm good, Tom. Always a pleasure.
Always excellent to have you on. And I'd like to start today by asking you, looking at 2025 so far as a whole, how volatile has this year already been?
It has been pretty wild. I mean, it has shooken people to the core. I think we've seen some record volumes on the New York, not on the New York Stock Exchange, but in the stock market as a whole. There's a lot of big volatility. Usually brings a lot of algo trading systems, scalping systems. There was a lot of volatility with Trump and tariffs, creating a lot of fear and panic and uncertainty. So the volatility has been huge, not just in price action, but in emotions. People are all over the place, super happy, super upset, confused. There's a lot of uncertainty. So it has been volatile across the board, from your bank account to how you feel and your fears of what's going to happen throughout the year and the next several years, with a lot of stuff coming around in terms of business and economy, in terms of a recession coming and all of that stuff, and AI and robots. I mean, it's going to be very interesting what unfolds. But this year has been, I think, enough to shake and rattle most investors to start to wonder, what do I do with my money and where should I go and what are the charts really pointing to?
Mm-hmm. So does that make, considering that volatility, does that make for a good trading environment? Or is it just dangerous and people end up getting gun shy because, maybe their paradigms of how these markets have worked is thrown up in the air?
Yeah, that's a good question. This is the one thing I struggle to get through to listeners is there's multiple answers for that, depending on the type of trader or investor you are. So, for example, is volatile price action great for trading? It is awesome for day traders. It is absolutely amazing. You have huge intraday swings and big follow through and runs. So it is great for a skilled day trader. Swing traders, this environment is pretty dangerous. We have massive gaps to the upside and downside, like 3-4% some days for the indices, which is massive. Stocks gap, 15-20%. So swing trading is a little more dangerous. I wouldn't touch it here. For a long-term investor, this is a point where you really need to focus on protecting your capital, moving to cash. Based on my model in the weekly chart of the S&P 500, we moved into a bear market several weeks ago, or a month and a half ago, 2 months ago. So as a long-term investor, you really just want to step aside, let this market sort itself out, let the economy come full circle. I believe we're going into a big meltdown in equities and a lot of different asset classes, including real estate. And so you don't really want to be holding stocks. And so there's a bounce going on in the market right now, which I believe is a bear market rally or a dead cat bounce. And I think it'll fizzle out eventually, roll over, and then we're going to go a whole lot lower. And we might not be back to this pricing for 2, 3, 4, 5 years. So a long-term investor, you step aside and ignore the markets, keep your wealth, protect your mindset and your emotions and all that stuff, and just prepare for a reset and an opportunity for you to reinvest when things are fair valued or undervalued down the future. So it really depends on your time frame. Day trading is great. Swing trading is dangerous, and long-term investors should be sitting on their hands, really in cash at the moment, waiting for this reset. If the markets turn up and we start to make new highs and all the signs are there that a new bull market is actually starting, which is possible, then you can get back in as a long-term investor. But you're way better to keep your wealth, protect your capital right now, and wait for this market to pick a clear direction. Right now, the direction is down, and this is just a bounce. And as an investor, you don't want to hold stuff falling in value.
Mm-hmm. Well, this brings up a point that I did want to get to with you today is this idea of the buy the dip mentality in these US markets. Many participants have been really conditioned to just keep buying these dips. So at this point, you're saying that there is a risk of a multi-year bear market developing. And as part of that, can you explain what gives us those indicators?
Yeah, the buy the dip mentality. I mean, most of the time the stock market is in a bull market. There's a natural upward bias in the stock market. Obviously, we haven't had a really crazy stage 4 decline, which if I share my charts, I can give people a bit of a visual of what this looks like. If we take a look at the market, you and I have talked about this a few times, Tom. There's 4 stages in the stock market. And generally, the stage 2, which is a bull market phase, is what the stock market is generally in for huge extended periods of time. And most people have gotten involved in the stock market really since like the bottom of 2009, so a long time ago, is just like buy the dip. Any sell-off, just buy it and it'll come back and you'll be okay. And it's worked out with relatively small pain if you're on the wrong side for a little while. But what eventually happens is we go into a stage 4 decline. And right now, I believe we're in a stage 3 topping phase. We're in this kind of complacency move where the general public think the markets are firming up and they're putting in a bottom and they're going to go higher. But the reality is things are breaking down under the hood. If you lift the hood to the stock market, it looks terrible. Everything is disconnected, broken. And we're about to go into a financial reset, which is like a 2008 type of crash, a 50+% crash. It's similar to the tech bubble crash. Every time we have one of these financial resets, a stage 4, it's for a totally different reason. And every time is very different. But the same thing always happens. Price goes down, people get fearful, and they sell stocks. And this is what people don't understand is the buy the dip works great. You're a hero until it doesn't. And then you blow up your account and you lose it all. And we never know which one of these little pullbacks within a bull market or a topping phase is the last, little hurrah, little push up before we go off a cliff for several years. And I believe we're getting very close to this cliff. I think we actually have already topped, and I think we're about to go lower. So the buy the dip mentality is people who I believe are kind of stubborn in the old way of like, hey, if you're 25 years old, you can buy the dip and let it ride. You have tons of time. But if you're like 45 plus, you're close to retirement, you have a lot of wealth, or you're retired, the last thing you want to do is buy the dip and then find out the next 8 years you're underwater. You've lost half of your wealth at one point. You're downgrading your lifestyle. So the buy the dip mentality has to be, taken very carefully here, and you have to have an exit plan because eventually we're going to go into a very big sell-off, and investors are going to go through like anxiety and denial. They're not going to believe how much they're down. They're going to hit the point where they're like, I'm down so much I can't get out now. I just have to ride it out. And then it goes on for years, and they've kind of blown up their retirement accounts, and it takes a long time. So I think the buy the dip mentality is simply just, to me, it's not a great play when we're about to go off a cliff on the economy and the stock market cycle.
So what are the indicators that are showing us that this, this going off the cliff is a possibility right now?
Yeah, so there's a lot of things that I look at. So this here is the SP 500 weekly chart. And based on technicals and money flows between various different assets, because pretty much everything in the financial system is linked in some way. If money is flowing out of stocks, it's probably going into another asset class. Could be just a currency or cash. It could be bonds. It could be gold. It could be whatever. The key is to know the asset that you're in, whatever you're trading, like the SP 500, you need to know when you're in a rising tide, a bullish environment, or if you're in a bearish environment. We just had a beautiful run from early 2023 up to about a month or so ago. That market kind of reversed. I believe now we're going to start to go off a cliff. And there's some early warning signs that tell us this. Like, a lot of economic data is actually showing signs of weakness. So if we were to take a look at some economic data, if we take a look at like hires, since 2022, 3-month average hires is coming down. People aren't hiring as much as they used to. We're getting right back down into 2015 levels for some of these spikes. If we take a look at the private sector, it is not hiring. The job openings are dropping off dramatically. If we take a look at the unemployment rate, we've seen it bottom out. Unemployment is still relatively low. This is unemployed in millions, not percentage wise. I don't think we're at like 7% unemployed, but we're starting to see this turn up. And this is a series of bull flags. You rally up, you create a bull flag. That's the halfway point. You have the next leg up. Now it has a bigger bull flag, which means this whole leg up, we could see push even higher, way up here. So unemployment is slowly starting to rise. And these bull and bear market cycles take months and sometimes years to slowly unfold, just as they are right now. So those are a lot of things that are coming. We've got, when we look into the housing market, we've got commercial mortgage-backed securities are spiking up on delinquency rates like they did, when we had the financial crisis. It spiked up after. We're already at those levels and beyond. The amount of single homes for sale in southern United States, like Texas, Florida, we're way above where they were in terms of the last housing bubble. There's all these things. People aren't buying homes. The inventories are building up. Pricing of homes has put in this topping phase. It is on the verge of dropping. So home prices are about to fall, I would say 15 to 20+% over the next year or so. I think it's going to drop off. There's a whole lot going on. And that's what people need to be aware of. The economic data hasn't fully reversed in most cases, but it is showing signs that is reversing. And so that's the economic side. Now, if we go and we look at gold is to me the ultimate barometer of fear in the market. And we'll just go to the monthly chart of gold. And if we go way back in time and look at gold, the last major super cycle in gold that started was way back here in early 2000. It had a big run up, and then it had this pullback in 2015. And so it has done its 100% measured move. Now, I always do these Fibonacci levels because Fibonacci is one of the most powerful sequences and ways to project forward pricing for stocks and commodities. We had the pullback. And my whole theory is if you run up and you hit this golden level, 618 is called the golden ratio. If you pause there, you almost always go up and you hit the 100% measured move. One stands for 100%. Whatever this move up was, you're going to see that move happen again. And so we hit that level and we had a little bit of a pause there. And now we're in this blow off phase. And this is like when we see these blow off phases happen, it's usually a sign of massive weakness or fear in the market. We saw a big blow off phase back over here. We had one here. It looks small, but this was a huge blow off phase. There was another blow off phase here. Each time we saw gold hit its 100% measured move just before it, and then we have these blow off phases. Each time this happened, gold rallied about 23, 24%, and that's where we're at now. And what happens, Tom, this is the way I see it anyway, is when the world gets nervous about stocks falling, about currencies, about all kinds of rules. Well, obviously tariffs are shaking things up, bubbles bursting, all that stuff. When there's uncertainty, people move out of the financial system and they buy physical gold. And when they buy physical gold, that is them telling us, or that's us saying, okay, nobody trusts the system. Even if they have cash, they don't want to put it in the bank because the banks might go bankrupt. So they're getting it outside the system. And so this blow off phase in gold, while yes, it's super bullish and it's still in an uptrend, it is screaming right now that it is like about to come falling down along with the stock market. The economy is going to follow. And to me, gold is like the ultimate barometer. This is like one of the biggest things that tells us the market, the financial system is close to a reset. There's a lot of other things of where money's flowing into utilities and different stuff like that. And the US dollar index, which has been punished. We're going to see the dollar index move higher and rally while gold falls. The sentiment, Tom, right now for gold is like everyone is like, get me into gold. They all have FOMO if they don't have gold. They need to get into it. If you talk about the dollar and that it's going to put in a bottom, it's about to rally, everybody jumps down your throat and says, no way, it's the worst asset. It's going to crash. The dollar is going to collapse. When you have those two extremes, everybody loves gold, everybody hates the dollar. Usually extremes mean turning points in the markets. So there's a lot of stuff, put all these little pieces together. It's not about trying to pick a top in the market or anything like that. It's about knowing it's coming, identifying it, waiting for the charts to paint the picture and the pattern or the setup, and then we take advantage of it. So we can profit from bull markets, we can profit handsomely from bear markets. You just have to wait, and we're kind of stuck in that in between right now of protect your capital, but get ready because there's going to be a massive trend, and we'll be able to benefit and be able to buy a lot of stuff at bargain discount pricing, probably 6, 8, 12 months or 2 years from now, whenever the market puts in a bottom.
So Chris, as you're, showing us those measured moves for gold, do you have a downside target on this, next leg down, as you're saying it?
Yeah, so there's a couple of different ways we could pull this. So if we use a Fibonacci retracement, so the other tool I showed you, Tom, was Fibonacci extension. That shows where price should extend to. It gives us an upside target. Well, when something does top out, there's a retracement saying how much price can retrace, pull back. The ultimate most aggressive pullback is going to be somewhere right here. So this is based off the low from the start of the last kind of bull market in gold up to this high. The sweet spot, the golden ratio really for this is around this 38 to 50% retracement level. And so that is bringing us down to 2,300, 25, 2,600 is that kind of potential pullback. If we draw that from the highs, that's about a 34% pullback as the sweet spot. And the crazy part is, if we go back to 2008 and we go from the high to the low, it was 34% pullback as well. So it's very interesting. Fibonacci has this funny way of working out and how price points are very similar. Time, it never matches identically, but a lot of things kind of rhyme in very similar type of scenarios. So there is going to be a good haircut, I think, in gold. And a lot of people are saying this time is different. And I'll agree. Every time the market does something, it's different. But I do feel like when selling hits the stock market, gold gets punished and it sells off as well. And a good example of this is if we go to the daily chart of gold, we saw the stock market had 3 days of panic selling back in the beginning of April. And those 3 days that the stock market had true bear market panic selling, gold dropped 7% in those 3 days. And that is just a taste of what happens in a bear market. Now imagine a bear market that goes on for 12 months. And on average, every week there's multiple down days and selling and all this stuff. Gold just gets pulled down with it. It's just the way the financial system works. Anything that's in the financial system, when investors start pulling money out, everything kind of just goes down pretty much. So anyway, that's the downside. Is 23 to 2,600 is the sweet spot, I think, for gold. And it matches perfectly with Fibonacci retracement. It matches with previous pullbacks. Doesn't mean it's going to go there for sure, but that's what you should expect. And that is going to be to me, the sweet spot. If it gets down into this area, that's where I'll be adding to my physical gold. It's also when we'll probably see gold mining stocks come to life, and probably when I'm going to look into individual gold stocks, because when they start a new super cycle, as you know, they can rally like hundreds or thousands of percent, these little gold stocks. So when they come to life and gold pulls back to this, I won't be looking too much into gold. I'll be looking more into gold miners or the gold miner ETFs, because they're going to have way more potential upside going forward.
Chris, what is the significance of that timing when gold pulls back to those levels? Margins are going to be compressed from where they are now. Like, the economics of a gold miner look much less favorable at a time when we lose, let's say, $1,000 an ounce from the price of gold compared to what it's currently at. So why is it that that's when they start to perform? Or is it that is also an excellent buying opportunity for the miners?
Yeah, I don't know exactly. I mean, there's an interesting. So I watched the thing with Jeff Bezos, and he was talking about how Amazon, which I can pull it up. There's been so many stock splits that you don't really see it anymore. But if you take a look at Amazon and we go to the monthly chart, he states it really well. So, for example, the stock market a stock price doesn't really represent the company. And people push back on that whenever I say that. But the reality is, we saw Amazon at the peak at it was like $110 a share because of stock splits and all that stuff. It's different value here, but we saw Amazon fall 95%. And Bezos was saying during that time, the company had the best numbers financially. They were growing by leaps and bounds. It was showing they were going to be an unbelievable company. Yet the stock price fell literally, I think it was like $110 down to $4 or $6. In this example, it fell from five down to like whatever, 40 cents or something, 30 cents. And so the stock price doesn't really have much to do with the company itself. All the stock price tells us is what investors think and feel about that company at any given time. And what really connected me when I saw him talk about this was this is a phase right here is where I blew up my first trading account. So I made a fortune here. I was like a superhero in college. Everything I touched turned to gold. I was like, I'm the best trader ever. And then down here, I was buying companies, buying shares, selling covered calls, and buying companies that were growing quarter after quarter. Super strong companies, yet the share prices would get cut in half, then they get cut in half again. And I blew my account up holding the best companies in the world. And so that's what people need to realize. The stock price and the company's fundamentals really don't have any say in what's going on. And I know, gold mining companies and all those companies are always pushing their fundamentals. Oh, we got a great story. But the reality is you need investors to be interested. And whatever the market is doing, if the stock market is in a bearish phase, this bearish bias is going to pull the price down. And so your question was, well, what about gold miners? Are they going to be a buy? And they're not going to look that attractive. I would say gold miners are going to have like a big haircut. I mean, I think they're going to come right back, settle back down somewhere in this range. And yeah, their gold is much lower. But I think other things will be lower too to counter it. If you want to talk about the fundamental side, probably fuel will be cheap, labor will be much cheaper. We're going to go through a big cleansing event for jobs. People will start to want to work for whatever job price they can get versus demanding and all that stuff. So, but you're right. Investors will see these companies getting undervalued and they'll look forward and be like, well, the fundamentals are really good. And now that we're out of a bear market, this company is fairly valued and it has a huge potential upside with the fundamentals. And that's when fundamentals kick in, is the start of a new bull market. If you find a company that has a good stock price trend, it's up, has good sentiment among its investors, and they have good fundamentals, then you've got a rocket ship. But really, when the market sells off, miners are going to get hit, and investors start to move into them first. It just seems to be gold bounces before the stock market and the economy does, and people move into miners, and then it starts to get attraction, and then the miners just usually take off from there and become that defensive play. It's just the way we've seen it happen in the past. I'm not sure 100% of the investors' mindset of why, but it's just the way we see it move.
Mm-hmm. One thing that you've pointed out recently, Chris, this idea of seasonality, both between the S&P and gold as well, is very topical coming into May, especially into the summer here. So
yeah,
is the seasonality in many of these markets different this year in let's say S&P and gold because of these situations that you've laid out?
Yeah, I mean, the market will buck its trend from seasonality wise. Obviously, the stock market has been struggling most of this year. Yet the seasonality wise shows usually we see a rally from January into June. And that's why they say sell in May. After May, you kind of sell and the market pulls back. 2 years ago, the stock market pretty much did this. Like you could overlay the charts. It was like signature type of move. This year it's going the opposite. The key here is to just realize right now the bias seasonality wise is for the markets to kind of go up. The tide is going to naturally push it higher. And that's probably one of the reasons why we're getting a bit of a bounce in the stock market and it's drifting and working its way up. Come June, though, the bias is going to be to the downside. And I believe that bodes well with this bear market rally coming to an end, rolling over in May or June, and then starting to head lower. And then we see it go a lot lower. I don't think this year is going to follow this seasonality chart so much. It's already way off. Some years it mimics it, other years it has no connection or correlation, which is why I don't use it for trading. It's just nice to have an idea of like, okay, people naturally move in and buy stocks into June. After June, it's like people seem to sell stocks and they go down. And if we take a look at gold, it's kind of gold is showing that it should be moving down into August. Right now, we're kind of just starting May. We might have a little bit of an upward bias and a little bit of sentiment for people to buy. But overall, it is showing that, we should expect a bit more selling. And based on the moves, that 24% move in gold, this blow off phase that I kind of drew on that chart earlier, I believe gold, it's still an uptrend. I wouldn't bet on it falling yet, but I do believe gold is like very close to topping or it's already topped. And if it does move higher over the next couple of weeks, I do think we're going to see selling step in and it's going to pull back. But seasonality gives you a good idea of kind of, if there isn't anything unique going on driving the markets, news driven, seasonality is a good idea of which way it should kind of drift for that time frame.
Mm-hmm. Well, Chris, one of the, obviously as another part of the metals complex, silver hasn't necessarily done what a lot of people expected it to do as well. Is this also a time that you see caution to be warranted within the silver market because of this risk to gold as the safe haven, the bigger safe haven play?
Yes, I'm not a huge fan of silver. Silver is starting to form a chart, a bullish chart pattern. So it has this rally and this bull flag. It is pointing that it could rally to about $28 per ounce, which percentage wise from where it is a very significant rally.
Sorry, you said 28.
38. So there's potentially some good upside in silver, but again, it's not the same play as gold. Gold to me is the whole world kind of moves into gold to preserve their capital. Like the fact that silver dropped, in just a 2.5 week window, it dropped like straight down 22%. Most investors, if they have a lot of wealth, they generally don't want to just move it into something that moves almost 25% in a week and a half, 2 weeks. That's a lot of risk. So gold is that big, slow, boring, moving, pet rock that investors naturally gravitate to. And so that's why we keep seeing money move into gold. Silver is the speculative play. It's much more volatile, totally different game. It does have upside potential, but if you're going to play the precious metals space, why not own the one that just keeps making new all-time highs, that is more stable, that keeps hitting its every target we draw, it just keeps running up and hitting those targets. So why not do that? Why jump into silver or miners when they're much more volatile, much more random, and you might not get we're all here to make money. And so gold is, to me, the easiest way to pull money out of the markets in this environment when it comes to the precious metal space. Silver is like you're swinging for the fences. You're trying to hit a quick grand slam, a big pop and a move. Trading usually isn't that easy. So I steer clear of silver until we have a new bull market in the precious metal space. And I believe silver will have a huge correction. Gold will pull back. Silver, I believe, will probably pull back into the low 20s. Like I think it'll have a big haircut as well, and it'll be an opportunity. And then from there, silver could be a very good play. Silver and miners both have very nice percentage returns. Gold is pretty slow and boring in a bull market. It feels like you're always underperforming, even if it's moving in your favor. So depending on the environment, when
everything is participating, though.
Yeah, everything's participating in a new bull market in the precious metal space.
Of course, Bitcoin is also mentioned quite a bit here, Chris, within that, let's say, that monetary space. I wanted to ask you if it has started to decouple from the NASDAQ, because they have moved very similarly for a long time.
Yeah, they have. Bitcoin has decoupled a few times. It keeps having this odd day where the stock market might sell off and Bitcoin pops and rallies. And then other days, if stock market goes down, Bitcoin goes down. it is a lot like what gold miners do. Gold and silver miners do the same thing. You just never know if it's going to sell off with the stock market or if it's going to buck the trend and rally as the one sector that's the safe haven for the day. So it always adds a wild card. That's why I think trading miners in Bitcoin carry a lot more uncertainty. Instead of a 50-50, like, oh, we got a 50% chance it's going to move with the market. This whole where it can just flip its relationship, drops your odds from like 50-50 to like a 33% chance type of move. You just don't know when it's going to snap and trade. So I do like Bitcoin. I think Bitcoin is on the monthly chart is drawing a very nice chart pattern. It is showing that Bitcoin could go to about $135 per Bitcoin. We did a trade earlier on this bull flag pattern where it shows us based on this rally up and this pullback. There's two targets on Bitcoin, which we traded these. We ended up getting along right over here. We sold out at 108 right up here. And now it's building another one of these bull flag patterns, which if I was to draw the same type of analysis, it shows that we should see a move on Bitcoin somewhere up to about 135 if it can break out. Now we do need the chart of Bitcoin to move up. It needs to get higher into this resistance zone, just like it did over here. It needs to show signs that it is turned up and there's people moving into it. And so if we can get that, it could be a great opportunity for a pretty explosive move. We could see it, rally a quick 30% if that happens. So it's another kind of trade setup I'm watching, but it's not quite there just yet. And again, if the stock market sells off, then I don't think Bitcoin's going to make that run at all. I think Bitcoin will eventually just get sucked down with the stock market. So the only way I think Bitcoin does this is if the stock market continues to drift higher, or if the stock market trades sideways and Bitcoin becomes, and gold kind of become that defensive play where people pile in as an alternate kind of asset right now.
Mm-hmm. Well, Chris, you've brought up, and we kind of touched on it earlier, but I'd like to go into it in a little bit more depth. This idea of people's feeling of wealth considering their real estate holdings, right?
Yeah.
Where do you see, or does real estate get sucked down as well, considering I guess we can start from the inventory levels at the moment, right?
Yeah, I mean, if we look at real estate, we can look at our real estate ETF. This isn't quite the same percentages you see in home prices, but you can see this is a real estate ETF from the 2008 top. We saw real estate ETFs fall 70, 78%. Real estate will get hit. And the big thing here is when real estate, I think, has this next leg down. So real estate, like in Canada and a lot of spots, it's down about 15 to 20%. Now there's other places still doing well, but in average, 2022, the housing market topped out. Most homes are coming down in value. There's huge inventory. Things aren't selling. And in order for things to sell, we're going to have to see a big drop in prices of homes. And so, as you just mentioned there, Tom, where this kicks in is once we have this leg down in the housing market, which I think will be like 15 to 25%, potentially, in a lot of home prices dropping. Most people's biggest investment is their home. And so when they feel their net worth dropping hundreds of thousands or millions of dollars as their homes and their rental properties all drop in value, they're going to start to be like, whoa, like, I can't believe we just wiped out that much wealth that fast. And then if the stock market starts to break down on top of that, now they've got this like kind of 1-2 knockout punch. They're like, okay, the best investment ever, real estate, which people believe in, and it's a great investment. They're going to be like, okay, it just got knocked out, and now our stock market plays are going down. Like, what do we do? People are going to see their wealth drop and it's going to keep falling. And that's when real panic sets in. And that's when we start to see selling across all asset classes. People just start dumping gold. They sell Bitcoin, they sell bonds, they start selling everything. I think there's potential that interest rates are going to want to hold up or go higher. I think the bond market could collapse and drop another 5 or 6%. And a lot of people have bonds still. And so the housing market is going to be enough for people to realize, holy cow, we're in a recession. Housing is dropping. And that's going to spook them to start selling stocks even more. And we're starting to see people search bear markets. I did this chart, which is really interesting on this blue line across the bottom of these charts is people searching the term bear market on Google. Now, the top chart is the monthly of the S&P 500. This is the 2006 to 2009. This was the bear market, the top of the bear market, and the bottom of the bear market, 2009. The bottom chart is where we are right now. This is the last year and a half or 2 years. And what's interesting is we have these big blue spikes in search. People are now going on searching bear market because we had a huge crash in April. And now everybody's like, is this a bear market? And a lot of people are telling me right now, they're saying, we just had a market bottom. The markets are about to rally to all-time highs. We're starting a new bull market. And my argument is, no, I believe people now are open to the idea that we could be starting a bear market. And I think the best example of this, or a way to kind of phrase it, is like, think of the ocean tide. If we know the tide is going down the ocean today, at high tide's at 6 o'clock, and then it starts to go down. Just because we know the tide is going down at 6 o'clock doesn't mean it's going to go even higher. It's not going to go down because we know it. This is what this is. This is a wave of people, the first early adopters adopting, like, oh my gosh, bear market is potentially here. Just because we know it doesn't mean it's not going to happen. And as you can see, we've had multiple big waves in 2008 where people just keep searching bear markets, like, what do I do? How do I protect myself? And we are entering a tide that we can't stop. I believe it's a global tide of people tightening on spending, businesses tightening up in every possible way, all that stuff. And so I think that's where we are. This is the first wave of people going, holy crap, we might be entering a bear market. And we're going to have many more of these waves. And I think this tide is going down for a long time. I know there's some sentiment charts out there saying it's like one of the highest levels of people, believing we're in a bearish environment and that a bear market is starting. And people are saying like, well, since everybody feels like we're in a bear market, it's not going to happen. Well, this chart really kind of just shows it. Just because we know or think we're in a bear market and a lot of people are searching it doesn't mean it's not going to happen. This is a tide we cannot control. And this is why the Fed, when we go into a stage 4 decline, the Fed starts slashing rates. They're trying to stop it. They're doing everything they can to stop it. You can't stop something like this. This is a global market, correction. And it's either you take advantage of it or you ride it out and, suffer the consequences of losing a lot of money and wasting, a lot of time, because it could take 5-10 years to come back to the prices we're at, for all we know. So that's what I find really interesting in the market is the sentiment. And I believe with the home prices starting to drop, people are going to be like, okay, home prices are falling. We're entering a bear market. Oh my gosh, I got to start selling stuff and raising cash to protect myself.
Well, another piece of this that I found quite interesting is it's not just people searching for the Google term bear market. It's also inverse ETFs, right?
Yeah. And I did a chart on this. This was really, really interesting. So this is the SP 500. This is February and March, and the low in April we just had. What's really interesting is this whole window right through here, February and March, everybody was saying they're buying the dip. They're buying the dip, as you were mentioning earlier, Tom. And I'm like, I'm trying to tell everybody on YouTube. I'm like, guys, don't buy the dip. If everybody's buying the dip, it's not the bottom. I mean, that is just a pure sentiment play, just alone right there. But the charts were saying we're nowhere near the bottom yet, percentage wise. People were buying this dip, and there's this chart here is February and March. This is telling us how much money people were piling into the leveraged long ETFs. They're buying the dip, they're buying leverage, they're piling into the stock market. I'm like, don't be buying this dip, because we're going to go for another swan dive, and you'll be lucky if it rebounds back up to break even when you're done. You're going to go through one hell of a roller coaster. And then of course, suddenly we have 3 big down days. And I remember this red day here was a Friday, and we closed at the lows of the day. And I was telling everybody, we're going to go through the weekend. People are going to see this. They're all going to talk about it and spook themselves out of trades. We're going to see the market open dramatically lower on Monday, which it did. They're all going to dump their shares at the open, which they did, and it created a flush even lower, this lower wick here. And then, of course, the market's going to put it in bottom right after they panic out. And as you just said, Tom, we had a spike in everyone on that day dumping their shares and searching inverse ETFs. How do I make money for a falling market? And now the market has ripped the other way and they're in maximum pain, sold at the low. And now they're like, backwards on a huge trade, pretty much doubling their loss. They lost all this and now they're like on it on the opposite side to the upside. So it just shows like sentiment is so strong. In fact, a lot of my custom indicators, I have an indicator right here, which if I just pull up the SPY, this is a 30-minute chart. This indicator here tells us kind of the trend of the market, short-term wise. Is the trend up? If the trend is up, we want to identify panic selling. I have these panic selling indicators. Tells us when the market has a dip where it should rally. In a falling market, if we go back in time over here, in a falling market, we're kind of looking at these waves of FOMO. So whenever we have a spike in FOMO, which means everybody's chasing prices up, usually it generates a kind of a sell short signal going, okay, this is a bounce within a bear market. And sellers are going to come in, they're going to drive the price down. Now, these are short 1 to 2 day trades, but they happen over and over again. We get these FOMO indicators, the market drops. We get a FOMO and it drops. And so the sentiment, as you were just bringing up, Tom, is people search for the wrong thing and they have the wrong feeling at critical turning points. Every time we see our indicators give us these FOMO in a downtrend, we know the market, this is the general public buying into the market because they feel like it's taking off without them. And it's proven that the pain of missing out on gains is way more painful than avoiding losses or taking a loss. So, this is what I love is following these indicators and taking advantage of these extreme swings in the markets of more or less panic selling and then FOMO. And if you track these, and put them together with technical analysis and long-term trends and shorter-term trends, you can do very, very well, navigate these markets. And this is like this chart, this 30-minute chart of identifying panic selling and FOMO. I actually share this in my book, Technical Trading Mastery. I show you like the formulas you can put in on TradingView or any platform, so you can identify these. It's amazing for short-term day traders, momentum traders, things like that.
Chris, I think the only chart that I had left on my list to try to go over with you is the dollar. You had mentioned earlier that we're possibly due for a bounce back in the dollar. So explain to us why you see that.
Yeah. So my belief is I think we're going to see the dollar. It is a very ugly chart the way it's been moving up. I mean, it has a pause, a rally, a pause, a rally, a pause, in a very, very ugly way. It does have a series of higher lows. It has a series of higher highs. So it is channeling and working its way up from a long-term standpoint. When I look at currencies, I look at very, very long-term charts. I don't really trade currencies. I'm in Canada, so I'll hold US dollars when they're going up. And if they're in a major bearish move down, I don't want to hold US dollars. I want to invest using Canadian dollars. So when we look at the markets, we have seen this kind of happen over and over again, where the tech bubble kind of burst and blew up, and we saw the US dollar shoot higher. When people get nervous, generally the country that seems to have dominating control of things, usually that currency tends to do well. The dollar is, kind of the reserve currency, although people will argue that, and the dollar has definitely been under some pressure. But we saw the same in 2008. We had a financial crisis, and the US dollar screamed higher. It doesn't look like much, but for a currency, I mean, a 25% move in a currency is pretty strong, especially when the stock market falls almost 60%. So these are huge moves in these currencies. And I believe we're going to see the US dollar, I think, go back up to these highs or even higher over the next several months, or maybe the next year and a half or so. I believe no one wants the dollar. They've beat it up really bad, and they've been selling it, and the sentiment is there. It's an extreme. Nobody wants the dollar, and that usually is a setup for the markets wanting to go higher. And the fact that we've broken this pivot low here, we've broken this pivot low over here, that is kind of a flush out low. meaning it's creating a broadening formation. It's created massive panic selling for the currency. Typically, when you see huge volume spikes, it usually signals like a top or a bottom. And it's usually like the masses having huge emotional moves and giving up on something or piling and chasing higher. So I do think we're going to see the dollar work its way up. My main reason is I like to look at the Canadian currency, which is kind of where I'm focusing on. If I look at the monthly chart of the US dollar to Canadian, it's put in a massive bottom over the years. It's been trading sideways. And based on this chart, I think we're going to see the Canadian or the US dollar Canadian exchange continue to push up to like the 160, potentially even higher. And so I want to hold US dollars because it's worth more Canadian dollars. So that's the view I'm looking at it. This is a very, very bullish chart still. And that's why I hold it. Not so much because of the dollar index. The dollar index chart, as I pointed out, is very ugly. It's all over the place. But when I'm looking at it in terms of the Canadian dollar currency, the Canadian dollar has just pulled back to a major support zone, which each time it's hit this level, we've always seen a big pullback. And I think this time we're going to start to see it find support and rally. So I like the dollar because in terms of my currency, the Canadian dollar, I still think it's going to have a very strong move. Obviously, we need to see if it finds support here. We have, new people running Canada. We have new people in the States. So we've got a lot of politics, a lot of stuff going on. See how that shakes out. But overall, I still think the dollar is about to find a bottom. The daily chart is showing early signs that it's putting in a bottom as well. It has a little inverse head and shoulders. It has a little bull flag. Now, these are very small patterns, but we could see a pop and rally in the dollar. And I think it could scream back very quickly and actually become a favored asset to own in the near future. This year has just been very politically event driven based around tariffs. And so usually when something is driven around news, that move tends to be given back fairly quickly once it dissipates. So I think we could see that happen. That's kind of what I feel anyway.
Chris, how does the crude price affect everything right now as well? You know, we've had a big slide in energy prices, and that there's a lot of people that, you know, are quite worried or let's say surprised by that move as well.
I'm not surprised with what crude has done. I mean, I've been talking about it really back over here. I was waiting for crude oil to break down below this blue line, the $65 per barrel, and I was saying like once oil breaks down, clearly breaks down below it, that is to me is a warning sign that the economy, probably the global economy, is coming to a grinding halt, and things are going to slow. And of course. Now everybody can probably blame it on tariffs and shipping coming to a grinding halt and uncertainty and businesses locking up and freezing all their spending and all that stuff. But overall, oil has kind of done this. This is the weekly chart. It did this about a month and a half ago. It broke down, and this is telling us, hey, probably expect the economy to slow dramatically. We're seeing like land transportation in the States, like overland. We're seeing sea containers dropping about 30% coming into Los Angeles. They're talking about it's going to be about 7 weeks before we see it on the shelves, where we start noticing inventory is drying up for certain products in places. And oil to me is that indicator just telling us that things are going to get pretty ugly and there's going to be low demand. Travel has dropped off dramatically to the United States, especially from Canada. It's down 70%. So we're going to see, you know, one of the biggest nations definitely starting to struggle a little bit because people are slowing down. And of course, they're huge consumers of oil. And we're going to see, I think, all this, not only the United States, but the whole world in terms of all the freight that has to come across and all that stuff. So oil to me is telling us expect difficult times ahead. And it's probably going to be here for quite a while.
Mm-hmm. Well, Chris, on that happy note, I really appreciate you running us through all these markets as usual. Always a great conversation. Of course, for anybody that wants to see more of your stuff, that's all available at thetechnicaltraders.com. Or is it the Tech Traders? I forget.
Thetechnicaltraders.com.
And on Twitter, it's at the Tech Traders, right?
Yeah.
Perfect. Chris, is there anything that you'd like to leave our listeners with to think about before we wrap up?
I think the only thing is really just for investors to realize that it's better to miss out on some gains than it is to lose 30 to 50% of your portfolio and downgrade your retirement or lifestyle. You can always buy back into the market. Who cares if you have to buy back a little later if a new bull market starts? But it's way easier to protect your money and give it a few months to see what happens before, instead of potentially losing money. This is a critical turning point, I think, for most investors. Mm-hmm. And that's why I wrote a book, Asset Revesting. It's why I'm on here trying to share with you, like, we are close to a massive financial reset that most investors who are new to the market, they haven't experienced if they came post 2009. So it's going to be something most people have never experienced, and they're going to realize it is way more painful than they ever thought. And it's going to waste a lot of time. So protect your capital. It's better to miss out on gains, live life, and then just reinvest later than it is to try and, recover, 10, 20 years worth of your life savings wiped out in months. It's pretty scary times.
Well, Chris, when you say the actual term financial reset, does that mean a new currency? Does that mean only in the markets? Like, what does that mean to you?
Yeah, good question. To me, it just means everything is getting repriced.
Okay.
Everything is overpriced and all that stuff. And finally, everybody just sells all their shares. All the leverage gets unwound. Everybody's trading margin and 2-3 times more money than they have. So once all of that is unwound, it is going to create a flood of selling, which drives the prices down. That to me is a financial reset. Okay, all the leverage is out of the markets, and now everything is at the value it should be. I like anyway. For a new start, for everybody to start using leverage again and re-overvalue everything over the next 5 or 10 years. And the whole cycle rinses and repeats. So it's not a new currency. It's just something that we've gone through over and over again many times, not just the tech bubble in 2008. I mean, there's all kinds of these financial resets. It's just a reevaluation event. It's either protect your capital or ride it down. The markets will recover at some point, but it's a lot of wasted time and a lot of wasted stress to ride it out.
Mm-hmm. Excellent. Chris, as always, it's a real pleasure to speak with you and get your insight into these markets.
Thanks, Tom. Always a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.